Welcome to the Dividend Talk podcast, episode 144. Why dividend growth vesting is the best. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJI. How are you, buddy?
I'm really energized because it's already, half April almost. Spring is fully up in the air. And today we have a full pack show and actually about a topic which is really interesting because we have never spoken about this. It's
Oh,
probably obvious having a Dividend Talk podcast, but we never ever took such a foundational topic. So I'm really energized by this one. How about you?
yeah, me too. Hey, the sun is shining over here. We're finally getting a bit of sunshine. That brings out a good mood in everybody. We've had a horrible March. So I'm looking forward to some sunshine, getting out there, getting outside again. It's all good. And hey, this is quite a landmark moment on the show actually, because I think you've got a special announcement to make.
Yes, definitely. Da-da-da-da-da-da-da. We are launching our first official web shop with Dividend Talk merchandise. Can you imagine? This means we're in the top of the mountain. We made it. We can officially say that we're there. We're finfluencers or whatever it is now. We have a side hustle. Now, all jokes aside, we just thought generally that it's really fun for our listeners to be able to wear something like a hoodie or a t-shirt that kind of shows your passion for investing. So we thought about some really nice quotes that are typically also passing by on social media or especially here in the Dividend Talk podcast. So, you will find the link to the web shop in the description of this podcast. Full disclosure, we make a 25% profit on this, on whatever you buy. It will be all reinvested into the podcast, to the software we buy and everything that we have. If some money is left, we will make sure we'll fund the ticket for Derek coming to Poland here. But look, think about quotes like, you can't borrow conviction, or a bit spicy one, maybe controversial, but if you want to go to your bank, you could wear one with bankers are wankers. I'm sure they will be happy to receive you there. But others like, from Drip, one of our persons that we engage a lot with, like, stick to dividends, boys and girls. Really like when we're talking about option trading or something like that. Or this is your classic one, Derek, buy the dip. Yeah. So we have some really nice ones there in the web shop. Check it out. If you feel that there's an iconic thing that we typically say here is missing, send us a message, put it on Facebook or Twitter. It's really easy for us to quickly design one and add one. And then you will have your special tailored hoodie, however you want, how you prefer it, at your doorsteps.
Awesome. Yeah, it's quite exciting. And I have to say, you've put in a lot of work behind the scenes to get it up and launched. So thank you for that. But I'm excited. I'm going to order one straight away, and I'll start wearing them, showing them off on my YouTube channel. Just show the world, show them our
Nice one.
merchandise.
I definitely also go for one, and there's some really nice ones. I honestly like the "you can't borrow conviction." I think that's one that I can really wear private, but I need to have a bankers are wankers. I really need to have one just because it's me. Yeah.
Yeah, I definitely think I'll have to get to stick to dividends, boys and girls, because it's a bit of a joke in work. They know I do the podcast, they know I do this, and they'll be asking about companies, and I just look at them and they go, they don't pay dividends, and they just laugh. They just laugh. So
Nice one.
I definitely going to wear that bring into work. That's what I'm. So what about actual news this week, other than promoting some of our stuff quite shamelessly there?
Well, generally speaking, right? I'm not calling out a particular news article, but the narrative this week in the media that I saw is like, "Oh, the dollar is dead." Yeah, that kind of narrative at the moment. Like Russia selling a lot of oil to China, the Chinese yuan is becoming more and more as a currency being used in the world. So, there's a bit of word about this, and also the US dollar is now back at what is it, $1.10 per euro, which is good for us because last year we were buying stocks for dollar parity, and now we buy again 10% more of American stock, right, for the same euro. So it's pretty good. I did see somewhere someone mentioning, well, this doesn't apply for the Swedish crown. I realize that it's also a bit the same with the zloty. But at least from a euro point of view, this is really good news. Yeah, just 10% is a lot. On every 10 shares you buy, you get one additional now again, compared to where it was like just half a year ago.
Yeah. Yeah, I mean, look, we spoke about that before. It kind of ebbs and flows. You never know where it's going to be. And I tend to try not worry about it. I don't look at it too much, but it'll take from you in one sense and give from you in the other. So we'll
But do
enjoy
you
it.
think that the US dollar is now officially in a path that it really becomes weaker and weaker? Like that it will be the end of the dollar as what it was before, as how we knew it?
Yeah, I think so. I mean, there's a lot of things happening macroeconomically as well, isn't there, around this new currency, BRICS. I think Brazil,
Mhm.
Russia, India, China, and South Africa, if I am saying that correctly. So they are all coming together to try and come up with their own currency to trade. I see Brazil were out today encouraging other third world countries and second world countries, maybe they should come away from the dollar. So there's a lot of talk and a lot of movement around de-dollarization at the moment, and I think it will happen. I think it's inevitable. Every dominant country falls at some point, but it looks like there's moves being made. But I really don't understand how it will affect it. It just obviously will, I would say. And it's interesting to see France as well jumping, flip-flopping between the US and China. They're playing a game there, but it's it's going to be interesting to see with the US dollar, but I think it's going to come under some pressure, particularly with the other countries now making it their main goal to come away from the dollar.
Yeah, for me, it's mainly geopolitics, and we'll see how that plays out. And I think the dollar is a result of that. But it's clear what China is doing at the moment. It's very clear. And, like you say, empires come to an end. I don't think it's coming to an end anytime soon, to be honest. America, for me, the ingenuity in this country, the science. I know politically it sounds sometimes like it's getting more stupid, but if you look at R&D and everything, what comes out of America, it's again open AI, right? That comes out of America. Also the wave of AI, and we've been only hearing like China is so strong in AI, but then this ChatGPT comes from the States. Yes, so I still see this as a technological superpower. The United States far more than Europe, and still far ahead of China. So yes, China is not anymore just the manufacturing place of the world alone. They upgraded themselves definitely over the last few decades. So it's normal that it gets stronger, but I can't see United States within the next 20, 30 years suddenly disappearing, unless they have their own civil war internally, but not on another level. So with that having said, I feel very comfortable with my American stocks in my portfolio. Very comfortable.
Yeah. Well, and from that perspective, I'm not selling my American stocks based on any of that kind of stuff. So
yeah, but that's the only reason why we should worry, right?
Yeah, of course.
If otherwise we shouldn't care about this at all. And it's the narrative. We see these narratives all the time popping up and going away, and it's like almost like there are spin doctors behind it or something like that, right? So, I mean, if anyone was scared about this, I'm personally not at all, and otherwise just call me naive. But if I get to get this kind of shit all the time in my head, I wouldn't be a disciplined investor.
Yeah, it's too hard. Like looking at the macroeconomics, as you said, it's always in the news. There's always tensions between China, America. You can see even now there's Taiwan was back in the news, and there's always tensions there, and it will influence us at some point. But while it's just speculation, I don't think it can influence you because otherwise you'll be buying and selling every second day. Okay. Actually, there has been some companies report earnings already. Some Louis Vuitton was one of them. I know we haven't looked or covered it, but they posted some quite strong results, which is, I mean, I find it so crazy. I don't know what it's like. Well, I do know what it's like in Europe, but like in Ireland, the price of everything has gone through the roof. You
Yeah.
can't go down the street without talking to someone and they mention how expensive everything is getting. But then you see Louis Vuitton, which is a luxury brand, selling goods at above average prices, and they raised their revenues by 17% year over year in
Yeah,
this
I
environment.
don't understand where people get the money from. Yeah, because what I only can tell you is that the liquidity became less, or let's say more tight, just because of all of the inflation. So are people buying this on debt, on their credit card, or what? I really don't get it. It feels for me really anti-pattern. You would expect that grocery chains like Ahold Delhaize are doing better because people cannot afford anymore to go all the time out for dinner now because of inflation, right? But there seems to be like it's almost like Wolf of Wall Street party in society, like cash is splashing against the walls everywhere.
And you think of the narrative that you've just spoke about, like it's all negative going into recession, wars, currency de-dollarization. All this is happening. China has been in lockdown in the last 2 years, so they are not
Yeah,
even contributing to this much at all, and yet they're still growing year over year
yeah,
by double-digit numbers. I mean, it's just incredible. It's incredible what
yeah.
they're doing.
It shows that we have some really strong European companies here. And there's also one question about this, right? About Louis Vuitton versus Hermes and such, and our thoughts about it. I believe from Wolf of Hardcore, who we had once as a guest on the show here. So let's take that question now, and whether we ever considered investing in that. Yeah, of course we do. But have you seen the valuations? And this is my issue here with these kinds of companies. I mean, they're also hiking nicely, of course, the dividends, but for me, they always feel too expensive, and I don't understand the brands. I mean, I'm not a guy with a Louis Vuitton bag, yeah, so I also don't have this feeling for the products.
I mean, they always look expensive, but they're always pushing out results like I've just spoke about. It's just it's so hard. I I feel like we will never get the opportunity to get these at a fair value because if something was to happen to drive them down, in my mind, it's going to be something big, and it's probably
Yeah.
going to be something that they can't recover from, and we lose out. But I would love to, particularly Louis Vuitton. I would love to own these guys, but it's just hard. It's
Yeah.
just too hard to spend that amount of money on that company.
Yeah, and I think I might own something in a pie somewhere on trading 212, but I don't consider those as holdings. It's for me kind of more like an ETF position.
Yeah, yeah, similar. Um, Dividend hikes. I don't think there's been too many to talk about other than
Yeah.
Procter and Gamble with a 3% dividend.
Yeah, many people on social media found it kind of a bummer, like 3%. And I'm thinking like, oh my God, man, they did 67th year of consecutive dividend hikes. I mean, give them a break, please. Yeah, they've been hiking like crazy over the last years, 3%. I actually like it when a company is a bit more conservative if they see like clouds in front of them. So I mean, I take these kinds of. I don't have a position in Procter and Gamble, but look at Unilever. It's not
Yeah,
been hiking it at all. Yeah. So I think it's quite decent. We had other stocks that were doing double digit hikes over the last year. I mean, they have paid 133 consecutive years of dividends. Yeah, so this really one of those iconic dividend kings, and you should just go on your knees and kneel for them when you see this company, because it's a king. It's really the king.
Yeah, but in saying that, I get what you're saying about 3%, but I would think 3% is a little bit disappointing. Let's look at Johnson and Johnson, for example. What
Yeah.
what do you reckon they're going to raise? Usually 5-6% is the
It
ballpark.
will be all the time the same, I think, 6% or something like that. But there's an interesting thought process because they are also spinning off the consumer business. So will they now break the 6% trend? There's a question like, will there be a small dividend cut? Because if they spin it off, there will be maybe less cash flow. So actually, the dividend hike is coming up for Johnson Johnson probably next week or the week after.
Monday,
So
I'd expect it. Yeah.
yeah. So what do you think? What do you really think? Taking the consumer health business also into consideration.
So I was thinking about this, and I honestly think it's going to be a low dividend increase. I'm saying it's going to go up to, what are they, 113 at the moment per quarter. I think it's going to go to 115, which is like a 1.27% in
Yeah.
the dividend hike. I think it's going to be small. I really do.
Yeah. I
Yeah.
still think they will do a 6%. And why? The consumer business is probably 10 to 15% of cash flow.
Yeah.
So they might go from, I don't know, payout ratio from 55% maybe to 65% now. And their drugs are growing, the predictions are good. So I think they will just stay with the clockwise dividend hikes.
Yeah.
I think so. I mean, sometimes I wonder, I worry about actually a company of Johnson Johnson, because General Electric was doing the same. But then I read the book about General Electric, and they were just every quarter quickly shifting some money to make the numbers like clockwork, right? But you could almost say it's fraud. Yeah, it was just too complex, the business, for auditors to figure out what they were doing. But just on the last day of the quarter, quickly selling for 200 million in small business or something like that to make the earnings look good, as clockwork. So sometimes I wonder, like, how is a company like Johnson Johnson, which is quite a diverse business, not showing really a lot of diversity in the earnings and in the specifically the dividends, right? You would expect like a tough year and then a bit more lower hike, but over on average. But they are doing it like clockwork, so it's almost too good to be true.
We should probably see a little bit more of that now that when they spin off and the consumer health is not there, that consistent 10, 15, 20% of their cash flows is gone, and they're
Yeah.
purely a biotech company. We will probably start to see a little bit
Yeah.
more, little bit
Yeah.
more volatility there. But yeah, it'll be interesting. Like it's a really intriguing one. This one, I believe, part of me wants to believe they're going to stick with the 5-6%, but I just think, with the spin-off, I think we're primed for them to have a synthetic dividend cut where they will cut it in line with the cash flow. So we'll see. Now they
Okay.
might raise it to a little bit and then cut it when they spin off again, and we'll be back to the same level. I don't know, but I think it's going to be small.
Okay, cool. So below 4%, I take a vodka shot. Above 4%, you take a vodka shot in the next show and after the announcement.
Yes, sounds like a deal.
Good. The only real vodcast that we have here.
Okay,
Good.
why is dividend growth investing the best? We have, as you said,
Well,
we've never spoke about this before.
I can give you full disclosure. I'm really not biased. So everything I say here is without any bias. Yeah, I want to be totally clear here that the listeners don't think that I am, I don't know, biased about dividend investing or dividend growth investing or have any involvement in it or something like that. No, I really feel like I can speak objective.
So
This one.
your name then is European Investor. That's your name.
No, it's dividend growth investor. It's just catchy. Yeah. No, of course not. I'm the biggest hypocrite in the European dividend growth investing community. But look, because I'm so unbiased, there are just few bullet points that actually necessarily don't directly are about dividend growth investing, right? So why, if you ask me why this investing strategy is the best, what I really like about this strategy is that you need to find companies that can consistently grow their dividends. Now, what companies can do this? These are companies with a strong moat. Yeah, so what Warren Buffett calls like companies with strong barriers in the market that are hard to entry. For instance, strong patents for many years, or economies of scale. Like think about Ahold Delhaize. You cannot just build such a supermarket chain in 2 years or something like that. Yeah, so these are really strong established companies typically, and they have pricing power. This pricing power allows them often also to hike their prices for their products or services above the rate of inflation. Yeah, and because of these kinds of things here and their proven track record over time of earnings growth and such, sets it really up as strong, I said, high quality companies that grow over time. That's why I really, in its essence, really think why dividend growth investing is the best strategy, because the dividends are a result of this growth. And I mean, I think if you think about long-term investing, uh, like people think about Buffett and such, yeah, and Buffett always says like it's not about the dividends here and this and this, but the end. If you look at this dividend income that they have as Berkshire Hathaway, I mean, what can we say? Yeah. So, but that's for me the top reason. There's a few other reasons that I will mention soon. But what is for you the top reason why it's the best strategy?
So for me, without doubt, it's because it's relatively hands off. I don't have to pay, and I can't. I don't have the time, but I don't have to follow the market every day. In actual fact, I don't really know what's going on with the market from day to day most times. The market can go up, it can go down. There's lots of different news that can scare you and can throw you off. I can ignore pretty much all of that. All I need to worry about is look at an annual report or look at the quarterly earnings. What is their cash flow? What is their earnings? Can they afford my dividend? And that's really all you have to worry about. It's pretty much as hands off as you can get outside of ETF investing, which I cannot do. And I think I've spoke about that before. If it was a possibility when I was starting this journey that ETF was more accessible in Ireland, I would probably not have stumbled on this path. But
Yeah.
as an investment in Ireland, I think it's so hands off. It really suits my lifestyle. I don't have to worry about it. And like you said, just take it back from investing. All these companies, all your dividend kings, your dividend aristocrats. If you don't know anything about investing, you walk outside your door. I see companies like Sanofi. I see companies like West Pharma. I see companies like Tesco in the UK. Three of them companies are really consistent dividend payers. I know the businesses. I know what they do because they're close to me. I can understand them. And there's just huge businesses that will not disappear
Yeah.
anytime soon. And I think there's comfort in that.
Yeah, and those are usually industry leaders, like top 1, 2 in their markets. And if you think about it, I've got a few million of employees working on a daily basis in my subsidiaries, right? So I mean, and they're every day they're working, and when there's, for instance, a plant down, they wake up in the night, they get a call, and they fix it so that our passive income, our cash flow continues to ripple in. I mean, I don't know if they realize, but they're working for us. Yeah, continuously, highly motivated, top-notch employees, best in the world. I mean, what do you want more?
Yeah, be your own boss is what they say. And as you said, I would love to actually, I might do that. Might look at all my companies, see how many employees they have, and then see how many employees I have. I must be close to 1 billion.
I don't know, but also look at the contractors that they have, and the whole ecosystem that thrives out of those companies, right? So I mean, this is really nice, and for me, it's one of the most passive forms of investing, as you say, because for many of these stocks in our portfolio, we need to check from time to time if the dividend is safe. I mean, you mentioned quarterly. I think we're a bit fanboys here, also with the podcast, but honestly, for most of the stocks, you only need to look once a year. Yeah. And if something with one of the companies happens during that year, I mean, if you have 50 companies, it happens maybe to one or two something that requires your attention outside of the annual report on a yearly basis. So, I mean, it is really also a low maintenance portfolio from that point of view. We make it a bit more high maintenance, but because of our passion, but it's generally low maintenance portfolio. The only thing is always like the research, right? The initial research that really consumes the time.
Yeah, it is. But like I said, a lot of these companies are companies that everybody will know. Coca-Cola, for example, like, you don't need too much research into knowing what they do. You're really
Yeah,
looking at the numbers there. That's pretty
yeah.
much it. It's not like these growth companies like I don't know, or is it D-Dog or something? I don't even know some
Datadog or
Datadog like
Snowflake or Snowdog or Palantir.
C Limited and stuff. So you
Yeah,
there's a lot more research than new companies. Like, and you have to try and understand their business models, what they're doing, how they're making money, who their consumers are. Are they even going to be around in 10 years' time? Whereas
yeah,
I can definitely say to you, Coca-Cola will be here in 10 years' time. Johnson
yeah,
Johnson will be here 10 years' time. Texas Instruments
yeah.
will be here in 10 years' time. So I find, yes, there is research, but I don't think as much research is needed as it is with like younger
Yeah.
startup, smaller
And
growth companies.
and this also reduces the amount of speculation that you're doing versus investing, right? And that's also really what I really like about it. And for instance, you know what is maybe what we actually don't really discuss about ever in this show, but because of the dividend growth that you need, which is a result of cash flow growth and earnings growth, you have a lot of potential for capital appreciation at the same time. Because if your capital wouldn't appreciate, but your dividend would be hiking, your yield would really increase as well. And usually this goes a bit in lockstep as well. So also from a total return point of view, you get this as well, right? So you also see your portfolio value growing over time if you
Yeah.
invest in these kinds of companies.
Yeah, I think that's the biggest misconception out there. That everyone talks about these huge and look, you can hit a home run with a growth company. You can maybe hit a 30, 40, 50%, even 100% returns that you might not see in your typical dividend mature growth company. But I mean, if you're earning 20% on your capital appreciation and then you're earning 6% raise every year on top of that, it adds up quite quickly.
Yeah, exactly. And I can see it in my holdings as well, right? And then you only need like maybe 1 out of 5 of those holdings that do a bit better than the rest, and they will pull up your whole portfolio with that as well if you're interested in the total portfolio value. What I also really like about and why dividend growth investing is just the best strategy. You don't need to sell shares to how is it? To live off income. So it's not like the 4% rule where you need to sell shares and touch your capital when you need the income. Yeah, if you want to live off your portfolio, no, your portfolio is spitting out the income for you directly on your bank account. So you don't need to sell shares. You don't care then if it's at the bottom of the market or the top, which we even never know whether it's a bottom of a top or a top.
Yeah, I mean, on that point, for me, it makes it easier to calculate my retirement. Okay,
Yeah,
everyone knows. Okay, that the market earns S&P 500 earns, I don't know, on average maybe 8%,
yeah,
6%, whatever it is.
yeah,
But you're not guaranteed to get that investing in specific
yeah,
companies, companies.
yeah,
It's riskier. But at least with dividend growth investing, I can say, okay, on average, I know I'm going to get around 67% dividend growth year on year. I'm investing X amount at a portfolio yield, which is around 4 to 5% at the moment.
yeah,
So I can more easily predict my
yeah.
future cash flows and what I'm going to do with it and when I can actually retire. When you're basing it on share price fluctuation, what are you going to do in the likes of
Yeah,
2020? You're waiting 10 years. Okay, I've been compounding.
yeah.
2020 happens and half your net worth is gone.
But think about why do you invest in its purest essence? In its purest essence, you want to do in the future something with this money.
Yes.
This money is what we call income. If you sell your shares after 30 years, you do this because you have a purpose for this. It makes no sense to only do it to build the capital for when you die to give it back to the tax office or the government. If you do it, you want to give the wealth to your kids, as an example. But then why? Because your kids will want to do something with this money. So in the end, investing, you do it for income generation. Now we do it more for monthly income to pay the bills. Others maybe want to pay a house, buy a house with it or whatever. But in the end, you do it for income. And this is where dividend is also really, dividend investing is again so nice, because the income is coming out of your holdings already as an interest payment, let's say, for holding the shares. And yeah, this is for me just, I mean, there's just no better investment strategy. I mean, I mentioned already, I'm not even biased.
Purely not biased. Actually, Simply Dividends have a nice blog article on this. They give 5 reasons why, with a lot more maths and science behind it, including total returns, which we haven't even touched on. We know that dividends make up a huge portion of the total return of the S&P 500, particularly when reinvested. And we haven't even spoke about reinvesting dividends and what that can do to compounding your results as well.
Yeah, but I see it now, right? I can see what my projected annual dividend income is, and if I would need to save this on an annual basis, it is quite some salaries, right? Maybe already, let's say, half a year or more of investments, almost 6 or 7 months, and this is now just what I get from my portfolio as a yield. Yeah. So, and it's all reinvested. I mean, yeah,
Yeah,
I can see it in the numbers. Because I have in my portfolio sheet, I have a stat. I've got kind of the cash deployed to my brokerage account, and then I see the amount of dividends received over a lifetime, and then the total portfolio value. And I can see that the dividends received and reinvested actually, therefore, is already quite a significant amount of my capital. No, I would say portfolio appreciation.
yeah. I mean, when you look at it from that perspective, I can start to see that already. I started out, as you know, investing 1,000 a month. It's slightly above that now, but I'm due to earn €4,000 this year from that. That's 4 extra months of money that I can reinvest into my portfolio. I mean, that's compounding. That's
compounding. Others will say like, if you put in a growth stock, it grows with the same amount or something like that, right? And they find dividends a waste. Maybe they are right, and if this dividend irrelevance theory as well. And I think we spoke about it one time. But if you're an early stage company, yeah, you need all the cash. But at the moment when you're a blue chip company, well, you can put it on the balance sheet, yeah, and have it doing nothing at almost 0% yield. Or you just give it to your shareholders. Yeah.
Give it to me. Just give it to me.
Exactly. Yeah. And so for me to conclude, really, I mean, all of this, in my opinion, is better than pure growth investing, because that's for me also more speculation. We mentioned already, stable businesses, big brands are easier to understand typically. Business models are easier to grasp. Palantir is not easy to grasp, as an example. So there's also for me a little bit less risk involved, at least perception of risk, let's say like that. Yeah. Yeah, and I mean, I don't even want to talk about investing in gold or Bitcoin or any of this stuff, because for me that's just speculation. And let's not even start about trading, which I don't call investing. This like looking at a few lines on the screen and betting whether it goes up or down. And I guess some people are really good in that. I do believe that technical analysis has a place. I really believe in math and patterns and these kinds of things. But if I see sometimes those people sitting behind the screen, I see addiction, and then I'm rather just addicted to dividends coming in.
Yeah, you're kind of sacrificing your life a little bit. You're in front of a screen the whole time. I know I did a small bit of it in my days as a sports trading person. But yeah, I echo what you're saying. For me, the only thing that would come close to this is ETF investing. That's the only one that I would say can rival dividend growth investing.
Yeah, true, true. So I think we made a solid case. If people want to challenge us, they can try. But I mean, it's not even worth our time to respond to that. So to our listeners, as we said, we are unbiased, but we're also not open for feedback. Dividend growth investing is just the best. It will stay the best, and we will not change our minds.
Nice one. On that note, we will go and review a portfolio that we got from Casper. I'll just give some commentary. He sent in a bit of text about his portfolio just to give some context. And there are 37 companies in the portfolio with a starting yield of 4%. Top 5 positions allocation is 28%. Top 10 is 45%. He's 37 years old and he lives in good old Ireland. And like
Ooh.
me, there's no ETFs because he knows the pain of this deemed disposal rule that we have over here. Started investing back in 2018. He switched to dividend growth investing because of our dear friend Ian Lopuck. He came across his amazing channel and started his journey along the way. So I'm just going to call out his top 5, 6, maybe 7 companies. There are some good companies throughout this whole list, by the way. But I'll just go to, in order. Number 1, Johnson Johnson. Number 2, AbbVie. Number 3, Microsoft. I already know what you're going to say. Number 4, Texas Instruments. Number 5, T. Rowe Price. And number 6, British American Tobacco.
So what am I going to say, my
I
friend?
mean, this is a quality portfolio. I mean, it's littered with top quality names.
If you have Johnson Johnson at 8.3% as your largest holding, then salute. Yeah.
Yeah, I mean, he's got a good mix. He's got a good diversification mix. He's got a good sector mix. He's got
Yeah.
high yielders. He's got low yielders. He's got compounders. I really like this portfolio. I really do.
Yeah, it's a really nice composed portfolio. I also like something like, I mean, it's in the second half of his portfolio, like General Mills, yeah, canned food. I mean, this business is as boring as it can get, and it is a slow compounder, but these stocks are just really, really good. Look, there are some things in there because, I mean, I'm a bit allergic to this, but I see Bank of America in there, JP Morgan, also Western Union. I know Thiago, who was once on the podcast, he is looking at this as a cigar butt, but I wouldn't take it in my portfolio. So there are a few of those that I don't like, but he has quite some financials in there, like he mentioned, like Tiro and also now NN Group. So I think he has a pretty decent portfolio, but I would get rid of those banks. But again, as always, I'm entirely not biased.
Yeah, I mean, I don't mind the banks here. The banks he actually has are if you're going to pick American banks, they would probably be the 2 or 3 that.
Wells Fargo with the 8 credit cards per person and the major fraud.
Wells Fargo, pretty much Bank of America. You would JP Morgan. You would. Is Wells Fargo there? I can't see him.
I thought I saw them.
Maybe
not.
maybe I don't see him, but I see Bank of America, I see JP Morgan, Western
No.
Union.
No, Wells Fargo's not in there. My bad.
What I do see is Smurfit Kappa, the little Irish company, the packaging company. I do like that as well. I went for Sunoco at the time, but he stuck to his Irish roots. Went for the good Irish company. No, but honestly, I think it's a really well laid out portfolio. There's Visa in there. There's Disney. I don't know if he bought Disney as a dividend company at the time. They are now reinstating their dividend. But yeah, it's a really good portfolio. Well done.
Yeah. Good. So Casper, and he excused himself for not being so active, and he just created a Twitter account just to, do this because I guess he's like a social media introvert. But he's been following us since June 2020 and listened to all the shows. So Casper, I mean, thank you so much. It's really an honor to hear that you have been listening so much and you've got an awesome portfolio. Well done.
Cool. So we have quite some questions to get through. So we will. This could be a long one. We'll do our best.
Let's do it in a rapid mode.
We'll see. Some of them deserve a
Yeah.
little bit of attention. So
Yeah, true.
we'll see. So we'll start off with an easy question. What cars do you drive, and how do you think on the personal finance regarding cars?
So first of all, I'm not a car boy. For me, a car is a vehicle that needs to get me from A to B. And the good thing about it is you can do this with multiple people. It's a bit hard to take my wife on the bike together with my two kids. I mean, I could put my wife on the front of the steer, and then my son probably between the saddle and my wife, and my daughter on the back probably. But it takes a bit of effort, and if it's like more than 5 kilometers, it's also a bit far. So there's a benefit in having a car. But I bought my car in 2012, and it's a Hyundai, gray, as boring as hell. It was cheap. It's a family car. It has now 130,000 kilometers, and I want to drive it until the end. So that's simply it. And I hate paying for this stuff because, yeah, that's me. I'm frugal in this space. I try to avoid any expenses on this stuff.
I am the exact same. You've seen my car. It's a Skoda Octavia. I've had that car about 2 years now, paid in cash. I don't like to spend a lot of money, so it was relatively small money for that car. Before that, we had an Opel, which we had for about 10, 11 years, and we just drive them into the ground. That's so I'm hoping to have this car for another 8, 9 years, and then buy another car for small money. I don't really care about cars.
Yeah.
Everything you've seen where I live, everything is quite close. I can walk most places if I need. My workplace is close, my parents are close, all my friends and family are close. So we only need it when it's raining, which evidently is quite a lot, but
Yeah, and like you, I never took a loan for a car.
no.
Yeah.
I did my very first car.
Yeah.
I was 18. I took a loan, and I learned the hard way because we hit the global recession at that time, and I struggled quite badly. So I had a high-paying job that got cut, and that was the lesson I needed. Actually, I was never ever taking out a loan for a car again, ever.
Yeah. Good. Interesting question, because it's a lot about personal finance here.
Yeah. Ron Kingpin, good morning, dividend investing peeps. Can you define what a full position is for your specific situation?
So full position for me is depending on the tier system. If you're a tier 1 company, it means you are 4% of my envisioned target portfolio size there. So if it would be, let's say, 1 million, it would be 40K in this case, 4%. But also in conjunction with the yields of a 3.25% yield or something like that on average. So sometimes it will be a little bit less or a little more, because I actually try to do the 4% on the dividend income more than on the portfolio size, or say it, the position size.
Yeah. Mine's roughly around 5%. I don't want any position more than 5. I do have some as you're building up positions, but by and large, I don't want to have anything more than 5% of my portfolio.
Yeah. And then the next question is from Joris Eveleens Maarse, and he is asking which stock to buy: Mercedes, Aston Martin, or Ferrari.
So I was looking at Aston Martin, and I don't think they paid dividend, so they were gone straight away. So then it's between Mercedes and Ferrari, and just on dividend history only, they're both very, I would say, not erratic, but they don't consistently grow their dividends, and they are prone to cutting them. But I think Mercedes has a slightly better history. I'm going off Kyphin, just looking at Kyphin off both of them. Mercedes would just edge it over Ferrari. And in Formula One, I think I prefer Mercedes as well, which is quite controversial. So I'm going to stick with Mercedes.
I would go for Ferrari because they have the best ticker symbol in the world, and that's RACE, RACE. So that already deserves my money. Secondly, talk about a car with pricing power.
Yeah, I mean, everybody wants a. Yeah, if you ask me which car would I rather own, a Ferrari or a Mercedes, it's a Ferrari all day long. A red Ferrari, that's everyone's dream.
Exactly, exactly. So I would go for Ferrari, head over fist. Good. Then Chinedu Onoinye is saying, "Hey, love the show. What do you think about ticker symbol VLGEA?" Now, VLGEA is what was it again the I forgot the exact name, but the supermarket chain.
It was a supermarket chain, if I
Yeah,
remember correctly. I'm not too familiar with them. I know they had a high enough yield.
yeah.
I,
So, I mean, I looked at, first of all, I looked just at the dividend history, and they've been paying since 2015 at 25 cents per quarter in dividend, never raised it. So, for me, that's already a red flag. I think they're a 4.6% yield, and that's the reason why I'm not even looking further. I looked a little bit on their website and such. It came across as kind of a family business, already existing for I don't know 80 or 90 years. So it's not a young business. I believe mostly in the East Coast in America. Very community oriented. So looks okay, but if it doesn't grow the dividend since 2015, then it makes no sense for me.
yeah, I mean, look, it is a small cap company, and looking at the financials, it looks relatively good. Everything is growing like it should. There's very little depth on it. Dividends are well covered. I think it's around 30 or 40% payout ratio they have. But as you said, the dividend history has been flat from 2013. And I don't know, I don't only have history as far as 2013. I don't know if it's been flat before that. So,
No, they didn't pay a dividend before, only in the
okay.
90s or something like that.
Yeah. So it's pretty flat. So you're not getting much growth there. So it's a 4.61% yield. Which is pretty flat. So then you're really, to grow your money, you're really looking at capital appreciation there
Yeah,
and
and reinvesting dividends. But
reinvesting dividends.
and so by the way, for full disclosure, the name is Village Supermarket. I just quickly reminded myself of the name, ticker symbol VLGEA. The same person is also asking about ZIM and CIB ticker symbols. I believe you can say a thing or two about that.
Yeah, Zim is a shipping company that was quite popular, but I believe, don't quote me on this, I believe they are now looking at reducing that dividend or even cutting it altogether. And they had some
Oh,
pretty high yields over time. And if you bought them in the high 60s, their share price has been decimated. Their earnings is quite cyclical as well. So I would just say be careful on that one. It's easy to get caught up in that high yield, but it can go just as quick. And there was talks of that from some people who would know that company much better than I would. CIB is another one. It's a high yielding company, 8.55%. Ban Colombia, they are called. They seem to be like a financial institution, maybe some sort of bank. Looking at the screener that I usually use, it looks a little bit more all over the place compared to Village Supermarket that we were talking about. So I would definitely just at first glance I would ignore a company like this. I think the attraction here is probably the yield, but I think in the financial sector there are some pretty good yielding companies out there that would be better suited than this. I'm thinking of someone like Legal in General. I'm thinking of NN, ASR. There's plenty. There's more T Rowe Price. There's lots more out there with high
yeah.
yield that I would definitely lean towards more than a company like this.
Nice. Good.
Stanley James has asked us your thoughts on the best ETF for the S&P 500, which also gives a dividend, and why.
Yeah, and I'm going to give a ticker symbol, which I believe is not accessible to Europeans because I've never really looked into this. from that point of view, right? Because I mainly look at dividend ETFs, but I would go for ticker symbol VOO because they have a 0.03% cost factor. And I said, but I don't know the exact yield at the moment. I believe over last year it was like an income return of 1.4%. So it's not a high yielder. But for me, if I look at this one, I mean, it is, of course, tracking the S&P 500. So that's what you get. But for me, that seems to be the highest or the best one. It's from Vanguard. I would typically go for Vanguard one when it comes to S&P 500.
Yeah, you had a YouTube video, I think, on dividend ETFs. Or was it
Yeah, but this is a question about S&P 500, right?
Yeah.
So I'm not talking about dividend ETF.
Sure. Okay. Daniel has asked us quite a morbid question. Can you talk about tax from the US stocks when we die? How is, in your opinion, do we prepare for it, split the account, etc.?
Yeah, so there is, first of all, we are all subject to this tax, right? This was 60% or something like that. When you die, that should go to the American government. However, in practice, I mean, they don't know you, right? So legally, you should submit it, yeah, tax form, and then they will harvest most of your portfolio, let's say. But what I will tell my wife is just like sell everything, otherwise, or just have keep the portfolio and just don't mention anything because the American government will not know. Yeah, so that's how I would look at it from that point of view.
Yeah, I'm the same. I will just tell my wife to log in, sell everything, put it into a bank account, and do whatever she wants with it.
Does your wife know how to log in? Because mine not. I mean, I will be just screwed, and it is something that I was thinking about, but I just didn't get to it to sit down to it to just explain her everything one time, write it down for her because we had someone passing away in our family, and I was the only one that knew that this person had a small portfolio, and I wanted to get the money out, and I really had to almost hack the computer almost via the password reminders, everything. I could kind of backtrace how to log in, but it was an issue because it was a kind of a forex broker, but the headquarter was in Greece, so I couldn't really easily access the money. They didn't accept our legal documents from Poland because they expect something more like according to the Greek regulation. It took me 6-7 weeks with threatening with police and everything there via email to get the money. Yeah. So I mean, this is the issue with these international brokers. Think about Interactive Brokers or think about the Hero. If your spouse, she needs to prove that you are married. Yeah, as an example. And then in this case, if you're, let's say, with Interactive Brokers might not be in Ireland, do they accept the documents and such? These practical things we ran into here.
Yeah, my wife might not know how to log in, but my sons would, so she'll be okay. Once there's one of the two boys around,
Yeah.
she'll be okay. But it's a.
I need to fix this, yeah, and I'm thinking just by adding her name to the thing. So in Interactive Brokers, you can do this.
Yes.
My wife's name is added there, but on the Hero, I don't believe so.
Oh, interesting. I might actually look at doing that myself on Interactive Brokers. Okay. Cohen has asked us, where did you guys learn your financial knowledge?
So some of it at university. There I had some semester of accounting and financial management, although I didn't do anything with it for 5-6 years. So, within 4 years, you lose almost all your knowledge. The only benefit I had is when I started reading about this, I quickly grasped some concepts and I could then find it back in the books that I had from university. But the typical books about Buffett and financial statements and such, that's where mostly got it from. But even Peter Lynch with One Up in Wall Street, that just simply explains, I believe, what the PEC ratio is. Yeah. Yeah, that's where I usually got it, and for the rest, it's just an accumulation of, you read the annual report, you don't understand what's written there, you start googling, you look up the accounting material, and you learn.
Yeah,
Ask questions on social media about it as well.
yeah, pretty much the same. Just reading books. Some books I spoke about how to read financial statements, one by Warren Buffett. I'm reading at the moment the little book of valuation by Aswat Damodaran. I'm about a quarter way through, but it's a fantastic little book. But you just, as you say, you pick up things as you go along. Yeah, books, Twitter, YouTube, and annual reports, financial statements, and then talking in general, talking to people, because you learn, not even talking, listening more
Yeah,
like listening to people. You learn quite a bit. So I've been blessed with this community. We always
yeah,
have these times where we jump on around Intel earnings. I don't know if we're going to do
yeah,
Intel anymore, but
yeah,
we've met some really knowledgeable people who has passed on a lot of
yeah.
information. So it's good.
And even between us, right? When we were wondering about, okay, goodwill, a lot of goodwill on the balance sheet, but how bad is it actually? I believe Alexander asked us this one time as well, right? And and then you start really reconsidering, like, how bad is it actually? And you start then reading, and then you form your opinion again. So my opinion is often just changing. Yeah, I would call it maturing over time. And I think this is also important, that when you're in this learning process, actually never stop being curious and thinking about what people ask and such, because they are often not asking to challenge, but to make us better investors as well, right? And genuine questions. So
Yeah, I agree. Matthias has asked us, he's currently searching for stocks in the healthcare sector which are fairly valued, with a good CAGR, fair PE, and growth. Not the large players, but rather small players. And he's come across this company in Hungary, which is called Gaydon Richter. What are your thoughts?
Gaydon, Gideon, Gaydon. I mean, look, I looked briefly into it, right? And it's a mid pharma company. It's their strategy as well. Has 200 products, I believe. They have also some over the counter generics. It looks like a solid company, to be honest. Based in Budapest as well. I actually don't know what the ticker symbol is.
It is Richter, Richter.
Okay, that's the full ticker symbol.
Yeah,
Okay, okay, good. Um, so generally um, looks good, but yeah, how I said, with when it comes to pharma stocks, I prefer big pharma because of the portfolio management. And this is a little bit outside of my comfort zone. So I really can't say anything I believe useful to you, Matthias. I think you found a very interesting company to study further. And I think it might be something. I'm just wondering, with such a mid pharma, like how much pricing power do they have with their drugs and such? Because when I looked at some of the drugs like cardiovascular, they're in quite competitive market. I saw they have a lot of generics and such. So yeah, what I didn't like, they had a 50% increase in sales in Russia as well. So Russia was one of their growth factors, and it's a little bit in my how I say it, in my sin stock where I don't like it category.
yeah, they seem to be quite diverse, and particularly in a lot of women's needs as well is one of their big players. They've had some medical devices, so they seem quite diverse within the medical space. Financially, they look pretty sound, I must say. And they look like they have a decent balance sheet. Revenues are increasing and growing. Free cash flow is nicely going. What I could not work out is what their dividend policy was. And I know you looked online as well to try and find it. It wasn't quite
Yeah,
clear. Um, their dividend per share, there's no real logic to it. It's yo-yoing up and down. I tried to find a trend with free cash flow and net income. It doesn't match either. So I don't know. It looks like they just wake up and think, I'm going to pay 20% this year, 40% next year, and pick a random number. So from a dividend perspective, it is in an upward trajectory, but it's too erratic for me. And honestly, investing in Hungary is probably not going to be where my competence lays either. So I would avoid it. But certainly, if you know the area, know the region, looks has all the hallmarks of a good company, I have to say, financially, and even some of the metrics that from a PE ratio, and some of the 10-year, 5-year CAGR total returns as well. So it
Yeah.
seems like a pretty nice find. It's just outside my circle of competence as well.
Yeah. Okay.
Uh,
The next one is Adam Bacon, and if you have such a last name, then I hope he's not vegan or vegetarian. It's almost impossible. But he's asking us about if we can give our opinion about the current stage of in the cycle of the cyclical stocks, like for instance oil and gas or materials, Shell or Rio Tinto. He's considering starting a position, but unsure if now is a good time. Of course, we never give financial advice, but we do have opinions and thoughts.
yeah.
For me, it's in the top of the cycle, specifically the oil and gas.
If you're looking at cycles, what's probably better at the moment is financials and real estate investment trusts. They seem to be getting put under a lot of pressure, whereas you have energy. I haven't been following materials, so I don't really know, but you have energy that are quite at the top,
Yeah.
and I would expect. I mean, look, I would expect them not to stay there forever. They will come in waves. I just think there is better opportunities out there. I don't want to, I don't want to put you off investing in these companies if you don't have them, because you get a decent yield, particularly for Rio Tinto. You'll get some good growth in terms of dividend growth of Shell, but in terms of capital appreciation, you could probably lose a little bit as well. So
I would say like the cycle is typically, if you want to know when you're in a downtrend, you turn on CNBC and they're all the time talking about the dollar price and such, and how companies can still be profitable. This it will be the conversation of the day. You will see lots of red numbers. You will see suddenly the price to earnings shooting up there, because now it's probably 4 or 5, but that doesn't mean it's valuable. It's actually peak profit typically. So these are the kinds of things you can look at. And specifically, if you are on social media and you hear everyone saying on Twitter, oil is dead, then you know you're in this season where it's in the lower end of the cycle. Bottom fishing makes no sense here, because you don't really know. But this narrative is what I'm looking for to see if we're at the bottom of a cycle.
Yeah. And the narrative we have now is every financial institution is going out of business, and every REIT is going to go out of business as well because of interest rates and so on. So
exactly,
that's where we're at, and I think that's, for me, where the opportunity lies. And what I'm struggling with is actually every time I want to go and buy something, I feel like I'm buying financial stocks the whole time. I feel like I'm going overweight on them, but that's where the opportunity
2 years
is.
ago, we had this with consumer staples.
Exactly. So half me is, I'm buying too much of it. Then half me is like, next year I could be buying too much technology. Next year I could be buying too much energy again. So we'll see.
Yeah, exactly.
Per Evers has asked us our thoughts on Medtronic. I know it's a company you wrote about before, and it's a company that I've always felt was overpriced, but looking at it now, it's down around the $80 mark. It looks quite compelling.
Yeah. I mean, I bought some not too long ago. I think around low 70 or 75. A small few. I mean, Medtronic, let's say like that, an iconic company. Yeah, effectively saved many people's life with the invention of the pacemaker.
Yeah.
He says it had a couple of rough years, but is now yielding about 3%. It's just the fact that it's yielding about 3% is just a matter of stock price, nothing else. The company struggles to grow its cash flow. That's the real issue with this company. There's a new CEO in, and I'm still not convinced. I think this business is in a very saturated market, lots of competition from Stryker and all these companies. And I don't see a clear growth factor for Medtronic. Yes, if I go to the slides of the CEO, there's a lot of mentioning of what the strategy is and everything. But in the Medtronic case, it is a bit seeing is believing. So for me, the dividend history speaks for itself, but everything can come to an end. But generally, in my mind, without now having the latest quarterly earnings in front of me, in my mind, I always think like, well, in the let's say the low 70s, that's usually for me to nibble a little bit in, but not like load up the truck.
Yeah, yeah, and to maybe give some validation to your point there, their free cash flow over the last 12 months is 4.16 billion, which is roughly around the same as 2016. So there's been zero growth in that time.
Mhm.
I know it's been
Yeah.
up and down slightly, and the dividend payout ratio looks quite high from both in earnings.
80 or something like that, 80%,
Yeah,
I
yeah,
remember.
just a rough value looking at it. Their dividends is 3.5 billion, and with a
Yeah, there you
4.1
go.
billion, yeah, it's quite high. So I can't see this 8% dividend increase that they've been doing over the last 5 years
Yeah.
continuing at that rate. But definitely, definitely, as you said, an iconic company, and coming around a fair value. But the question is, how safe is the dividend, or how can they keep growing the dividend? Is the question.
Yeah. I must say I'm quite proud that I all did this top of mind without any tool behind it. Just from remembering last time, like 3 months ago, reading the latest update on Medtronic for myself. So now I'm getting older, but some stuff sticks still in my mind.
It's sticking in there. It's sticking in there. Marek has asked us, how similar are your portfolios? I mean, how many of the same stocks do you have? I would say quite a few.
Yeah, but also not so similar, because always when I look at your portfolio, it is quite differently composed, right, than mine. And I think it has to do with the how long we have our portfolio. That's why I have Microsoft and Apple in there, because they were at a certain moment at really low PEs. Like I bought Apple at a 13 PE at the time. So you don't have those stocks in the top of your portfolio, right? So we do have different compositions here. You have also an interest in different stocks often than I have.
Yeah.
Yeah.
Yeah, but you can definitely see in terms of when we talk about cycles, we know we do have some similarities there. Like we have a lot of
Yeah,
oils,
true,
Shell, and
true.
now we've a lot of financials that are coming into
Yeah.
play as well. But different parts of the journey. Obviously, we have the Johnson Johnsons, Holdell Hazes.
Yeah, but who hasn't? Yeah.
Exactly. But you're right. I do have a part of my portfolio for high yielding CEFs, investment trusts, and so on, which
Yeah.
is something you don't have. You have more of a position in growth that I don't have. So they are quite different.
Yeah.
Okay, Elo has asked us a question. This looks long, so I'll try to read it as quickly as I can. It's a practical question. Like us, he has a busy lifestyle at work and stuff that does not leave much time for the markets. His question is, how do you practically buy stocks every month? Do you just log in at random and buy whatever has hit your levels, or how do you do it?
So, and he also mentioned something about placing orders, right, and waiting until it gets triggered, and he cannot do that. That is probably because he doesn't have a margin account, and with the Hero and Interactive Brokers, you have this margin typically behind it. So that's why I can do it. But look, honestly, I know whether. So I follow the markets a little bit, right? It's more like I've got my wish list in my allocation strategy of the stocks that I want to have. I've got one or two formulas there, which says like, okay, if it's above 2.75 yield, it flashes a little bit the color, and then I know like, okay, I can look at this one. If I know that I didn't buy anything in the month, I look at those companies. Usually there are like 4 or 5 in that wish list that are in the right color. And then I check like, oh, which one I haven't bought yet for a long time, or which one I could buy a bit more of. And then I check when did I last check it in my notes. And then if it was like a week ago and the price I see, and I just buy it. Yeah. And that really doesn't cost a lot of time. Really, really not. It's more like for me to remember, oh, I didn't buy anything yet this month, so I need to buy something now.
Yeah, I'm the same. I can log in on the weekend. Like if I log in Saturday, Sunday, place an order, it could get hit Monday, it could get hit. It could get hit
Yeah.
Wednesday.
Yeah, and I never do a market order because you never know how the algorithms work. Um, but I do work with limit orders for that reason, and sometimes they don't get triggered. But then on the Monday, I would just edit the limit order and then maybe take a market order because at that time there's enough trading volume.
Yeah. Okay. Second part of his question is, how do you think when positions are starting to grow? Let's say a position is 20, 30, or 40K. He knows that it's the same percentage spread over X number of stocks, but looking at the high number makes me doubt the decision.
I mean, if I would have positions with 40,000 euro, I would be already far retired. Yeah. So for me, this is not achievable, not realistic. These values, 20K maybe yes, in time, but I'm not even there yet. But I understand the question. What I've noticed that my perception to these numbers changes while my portfolio grows. Yeah, now there can be a day that I'm suddenly losing 2,000 euros on a single day. Yeah, just because of how the stock market responds. And if you just if I were just thinking about that for just a minute, that's a lot of money. With 2,000, you can really do a lot with a family of four over here in Poland. But the whole perception is changing when your portfolio grows, right? And when you have trust in your portfolio. So I actually don't think that it will be ever an issue for me if I see how I've been responding from when it was like 5,000 euro portfolio to where it is now.
Yeah, it's an interesting question, and I completely understand it. In my investing journey, I'm not quite there like you, but I would have had something similar when I was trading. As you go up and you're trading larger amounts, you're buying and laying is what you're doing to make a decent return. You could be turning over 40, 50K in a race. It doesn't mean you're spending 50K, but you are turning it over, and you had to. It certainly took a while to psychologically build up to that level. But what I will say is that once you have a plan, once you know the risk and you're comfortable with the risk, that's how I was able to overcome that. I understood the risk. At most was 5% at risk, and I was comfortable with that. It seems like if you're doubting your decision, you might be a little bit uncomfortable with the amount of risk that you're taking. That's probably what it is.
Yeah.
Just get comfortable with risk, and you'll forget about the digits on the screen. Paul has asked us, we saw what happened with Russian stocks after the invasion of Ukraine. How safe do you consider your Chinese holdings after the recent Taiwan exercises? Alibaba, I'm sure this is in.
Yeah, we spoke about it in the news of the week, kind of, right, with the dollar. I mean, I've got one holding there. I do have a lot of companies with sales in China. Yeah, whether it's biotech or Unilever. Yeah, I mean, I can't influence these geopolitics, and I wouldn't be able to avoid China exposure with dividend growth investing because Johnson Johnson, all these companies have a business in China as well. So, yeah.
I don't own any Chinese stocks, so.
No, but you do own companies with Chinese sales.
Yeah, that's true. Although the pandemic has probably slowed that down as much. They're not as reliant on China as they are, most of them.
Yeah, it depends. But for instance, I own some Starbucks. Yeah, then biotech is really often depending on China. So Unilever, these kinds of companies. So it has been the growth market for many companies over the years, right? Due to globalization, there was not so much innovation, more globalization.
Yeah, it'd be interesting. There's a lot of stuff in the news in relation to that, but I try and avoid block that out because it would drive me mad.
Yeah,
because you'd be worried about all sorts. But yeah,
Many Mystery is asking us about calculating intrinsic value, right, via the discounted cash flow model. and he's looking at do we do anything with maintenance capex and deducting that from the operational cash flow. Because if it's continuous thing, then maybe you need to do something with that, right? So usually it's not the first thing I look at. I try to keep it consistent in my approach, like operational cash flow just minus capex, like the entire capex. Although I do follow the footnotes many, and if something there is where, like to your point, that for instance, I said the maintenance capex is really in there, I usually tend to go to the more conservative side rather than keeping an eye closed. I think keeping an eye closed is usually what sets me up for failure. So I tend to be more on the conservative side with that one. And then usually I have this feeling like the market is not seeing it. The market is not pricing it in. I start doubting, am I wrong or not? But yeah, no, it just doesn't convince me then. But it's not the first thing I look at, because otherwise there are like 1,001 considerations you can have because of the company specifics and such. So I prefer to keep a bit of simplicity in there.
Yeah, I think sometimes keep it simple is the best option here. Particularly as you said, it's not an easy thing to find in the annual reports, and then you have to estimate it as well, which can bring in obviously some errors as well. So I don't. I just stick to normal capex.
Yeah.
Hobby Investor has asked us, what are your thoughts on ticker symbol CSL, which is Carlisle Companies, and ticker symbol SNA, which is Snap-on, in a potential recession context like the current one?
Snap-on for me is high on my list to buy around $200 if it ever gets there. I really would like to own the company. Pristine balance sheet. I like it.
Yeah, I mean, Carlisle Companies, I'm surprised you haven't heard of them. They have an incredible 46 years of dividend growth. The dividend growth has been quite good. They're quite diversified, but they are in the construction industry, roofing, they do like some brakes and frictions, there's fluid technologies. They're in a wide range of different buildings and solutions. They've withstood the test of time, 4.5 decades worth of dividend increases, so it's hard to bet against them. They're a good company. They have a strong balance sheet. I think they'll be able to withstand another, just depending how severe, but I think they'll be able to withstand it. I don't know how much the dividend growth will be. My only reason for these, I remember glossing over these a while ago, but their dividend yield is 1.3, 1.4, maybe even lower. It's too low for my liking.
Good.
Dividend growth investor, who's your favorite friend from Friends?
Yeah, this because I put a GIF picture of Chandler on there when I asked a question for the show today. And it was Chandler a bit dancing or something like that. And honestly, Joey is my favorite one. He's the funny one, of course, always like a little bit more the stupid one as well. But I like him the most. But if you look at my personality, I'm probably a lot like Chandler. Yeah, a bit crazy, a bit corporate. So yeah.
Mine would be Joey as well. Joey is, as you said, the funny one. So would have been Joey. Mario has asked us, what do you think about ticker symbol BALL at the current level?
Well, it's hanging, around my waist. Was it wrist? How do you call it? About my hips.
Yeah, waist.
And over the years, it has been sacking a bit down towards my knees. But what do I feel? It's better to ask my wife this question.
Yeah, so for those that don't know, Ball is Ball Corporation.
It's a company.
Company, of course they are. They are a packaging company. They package beverages. I know a little bit about them because they do have a factory right next to where I work. I know they make the aluminum caps for the Coca-Cola cans. They don't make the whole cans. They just make the caps here where I'm from. But that's not their whole business. They have a whole host of it. Looking at their dividend history, it looks quite okay. They've got 7 years of consecutive annual increases, so they don't always increase it, but it looks like they've been paying a consistent dividend since 2004. There was probably one or two dividend cuts in there as well. So, yeah, I would expect them, if times get tough, to maybe cut their dividend again. So they're not on my radar, but
But I tell you, Mario's trying to prank us. I mean, come on, what do you think about Bol at current level? Come on, this can't be a serious question.
if you look at them financially, they look.
No, look at the question. Okay, let's move on because he's pranking us, I tell you.
Casper has asked us, what is your opinion on the Gyro announcing new fees from May 15th? Seems that buying US stocks will cost €2 per transaction.
Yeah, I noticed this as well. I mean, this is the issue with low fee brokers. I think the Hero is having some troubles sometimes with the financial watchdogs as well. Probably they just noticed that they need to boost up their cost structure. They've been acquired. The same happened with the Dutch bank brokers at the time. Really great bank got acquired by Saxo. And they promised like, we will keep everything the same, and suddenly poof, maintenance fee introduced. Flatex buys it. Flatex is not doing so well. Boom. Second time already increasing the commissions. And I think we see this with a lot of these companies that over time they come in like, we're going to change the market, 0 commissions. And then once at a certain moment, there are investors that say like, hey, guys, we want a return now. Yeah. And this is what I see a lot with these there. Still, the Hero is really competitive pricing, but by now, Interactive Brokers is becoming, I think, one of the cheapest brokers available in Europe.
Yeah, Interactive Brokers is far cheaper to buy at the moment. But you have to think of these companies, they have to make money, don't they? And the fees are very, very low. So,
yeah. But I hope they reinvest a little bit in the Hero and a bit the quality. Also, a bit more like stop having this noise with the financial watchdog, right? Clean up your kitchen and give us a bit more trust again.
Yeah. Dave S has asked me a question about 2 real estate investment trusts here in Ireland. I'm going to take that question next week because I want to give it a little bit more time. They are 2 companies. I'm vaguely familiar with them, but I will not do the question justice just by looking at them for 5 minutes. So I will definitely look at them because I'm quite interested in looking at REITs closer to home. Dividend Yogi has asked us, he has 42 different stocks in his portfolio. What's your idea of the perfect number of holdings? How about you? How many are you holding?
I'm having now 40 something, but 40 is perfect for me. But my allocation strategy is now 50 just because of the show blogging. I see so many great stocks that I had to give myself some more space, but ideally 40. Yeah. It fits really nicely with my tier 1 to 4 strategy.
My currently sits at 38 stocks. So yeah, it fits in with the 40 tiering.
Yeah. Good. Hey, this is the end of the show. We had really many questions. We respect each and every one of them. That's why I've been answering all of them. The show is a bit long. That's okay for us, I hope. Not for you. If it is getting too much, let us know. But then we need to start discriminating by, having some policies in place that select certain questions and others not. So so far, I think we are still at the edge of being able to handle it. But that's it, Derek, for today. This was show 144.
We're getting closer to year 3 under our belt. It's been pretty incredible. But again, thanks to everyone for the questions. We do appreciate them. We do try and answer best we can. And those that we can't answer, we will definitely answer on the next shows. See you all later on. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.